Yep, I can answer that. Many people are familiar with compound interest, and I've heard that this is something that you have to use if you really want to make your money grow. But there are also some question marks to sort out, not just for beginners. I've even heard very experienced investors say that you only compound interest if you buy dividend shares and then reinvest the dividends. But this is not true at all. So does compound interest work for stocks and funds? Yes, it absolutely does. You don't need to get interest, but from stocks and funds instead you get returns. So it could be called compound returns instead of compound interest, or it's simply called compounding. When do you get compound interest or compounding? So you compound interest when you invest money in something that gives interest or returns not only on the money you first invested, but also on the money you earned on your investment. That is, when you get interest on your interest or return on your returns. So return from stocks or funds can be either that the price of the shares or the funds increase, so you get capital gains, or that you receive dividend payouts. And to get the best possible compounding on dividend stocks, you need to reinvest the dividend. And the compounding starts ticking on from the first moment that you start investing. But you will notice it more and more the more money you have invested and the longer the time passes. So how does compound interest for stocks and funds work? I think a lot of the confusion here is that when you first get the concept of compound interest explained to you, a bank account is often used as an example, where you get interest once a year, and that's it. But stocks and mutual funds don't behave exactly the same way as a bank account. The share price moves all the time up and down, and the fund price is updated once a day for traditional mutual fund, and for ETFs it moves like a share. So compound interest here would be like a continuous process that happens all the time. So you can think about it like this. Instead of interest, you get return. And instead of getting it once a year, you get it all the time. So instead of looking at what happens in a year, we can cut the time down to look at what happens in one day. And then we can cut this down to look at what happens in an hour or a minute. And then we can cut down the minutes to seconds. And really, we can cut down the seconds to infinitely small pieces, because compounding for stocks and funds happens all the time. But now it isn't that relevant to look at what your returns are in a second or a minute or even an hour maybe, because the price on average doesn't move that much in such a short time period. So usually we look at how the stock market are performing during a day, a month or a year, or maybe whatever time period we're interested in, and then we simply combine the results from these small time periods, and in this way we can find out our returns during, for example, 1 year. But it's not like there is a chunk of interest paid out in the end of a year. You are compounding interest all the time. So if we take a day as an example, let's say that your stocks or funds went up 1% during a day in which you just invested 10,000. So 1% of 10,000 is 100. So you've just earned 100. Then you're so lucky that the next day the stocks also go up by 1%, and now you're compounding interest or getting return on your returns, because now both the 10,000 that you first invested and the 100 that you earned yesterday will go up by 1%. So we take 1% of 10,100, which is 101. So now you get one more return today compared to yesterday, because you also get return on your previous return and not just on the principal that you first invested. And so it will continue. So now one extra might not seem like that much, but it will become a little bit more each time, and I will show you soon how efficient this actually is if you let it run for a while and let compound interest do its magic. So do you have to buy a specific stock or fund to get compound interest? No, you don't have to. You're compounding interest on all investments, where you get the return on both your money you first bought, for example, a stock or fund for, and then also the money that you earn in return from your investment. So it has nothing to do with whether you, for example, receive dividends or not. And what can you invest in that has compound interest? Yeah, as I said, everything where you get return on your return. So stocks, mutual funds, ETFs, fixed incomes and bond funds, savings account as well, if you get any interest, of course, cryptocurrency, AMC and GameStop as well, or whatever is the newest meme stock at the moment that you're watching this video, just to take a few examples. Can you get rich with compound interest? Yes. If you're going to invest yourself to wealth, then this is something that you need to take advantage of. If you're not YOLOing all of your money into the latest meme stock, preferably in options, but you will most likely lose everything, if not immediately, then within a couple of days. Take a look here to see what compound interest can do instead. Let's say that you buy an index fund for 100,000 and you get 10% returns per year. After 20 years, you would have 672,750 without doing anything but waiting, because of compound interest. Pretty amazing, huh? And as you can see, you compound more and more the more time passes. The first years were just over 10,000 per year, while at the end it's increasing by 50-60,000 instead. It's compound interest at work, and the longer the time passes, the more it will increase. This is why it's also called a snowball effect. And you could have gotten even more, of course, if you, for example, had contributed monthly and not been satisfied with a one-time lump sum investment. So say that you want to save for retirement. If you're 20 to 25 and you have about 40 years left till retirement and contribute 100 a month to an index fund and receive 10% per year, then you would have over $500,000 just in time for retirement, or 559,561 to be more precise, just by saving 100 a month. So if you want to become a millionaire till retirement, you can invest 200 a month instead. Then you reach just over $1 million in 40 years. I really wish that someone would have told me this when I was 20. If you're 30 to 35, don't be sad. With 500 a month, you will reach the million in your 30 years left till retirement. And as a 40 to 45 year old, you need to save 1,500 a month to reach the million for retirement. Now that you have only 20 years left. Still 20 years left, maybe I should say. And if you're 50 to 55 and have about 10 years left, well, then you will have to invest 5,000 a month to reach the million. A slightly bigger sacrifice than the 200 a month that a 20-year-old needed to save. And unfortunately, not feasible for most of us. This really shows how much time matters when compounding interest. So how is compounding interest calculated? If you're so advanced that you want to calculate this yourself, you can see the formula here. So the result is equal to what you first bought the shares or funds for, or whatever it is that you're investing in, times 1 plus the interest rate or the return, and then 1 plus interest rate or return is then raised to the power of the number of the time period, such as years, that you want to invest in. So say that you invested 10,000 and expect to receive a 7% annual return and want to know how much money you can expect to have in 10 years. Then we take the 10,000 times 1 plus 0.07 raised to the power of 10, and it becomes 19,671 and 50. Wow, so in 10 years you've almost doubled your money without contributing any more money except the initial one. So if you want to know how quickly your money will double with any other return, then you can use the rule of 72. So all you have to do is take 72 and then divide by the return. So if you think that you can get 10% return per year, then you take 72 divided by 10, which is 7.2, of course, and then the answer is that it will take 7.2 years to double your money with a 10% return. So guys, I hope this answered your questions. Otherwise, let me know in the comments below, and I'll see you again next time. Whew.